We're looking at May-June 2017. We're carrying on where we left off.
Yes, sir.
This is question 4. It's 32 marks, so it's also a long question. The last two questions were quite long. We had question 3, which was, I think, the longest one, which was out of 40, if I'm not mistaken. What was it out of?
The first two.
33. Okay, so 33 marks, 40 minutes.
Yeah.
This one is out of 32 marks, 38 minutes. So they're both equal in terms of length, both around 40 minutes long. And we're looking at independent parts, A and B. So you need to keep things separate again. So look at part A first. You've obviously got sub-questions here. So you've got A and then a required, B a required, C and a required. Okay, so that's actually quite nice. You've been given separate questions. Okay, so there's the first one.
Okay.
Time value of money. A. Doobie will be investing 2,500 annually at the end of each year for the next 4 years, an annual compound interest rate of 8%. Calculate the value of investment at the beginning of the first year by using the fact table. See again, do they want you to use the tables? I mean, this is 2 marks, or do they want you to use your financial calculator? Personally, I think the financial calculator is better. Why? It's more accurate. It doesn't use approximation or estimates or anything like that. The table methods do use approximation in terms of decimals and rounding and all of that. So the answers that you get in the tables aren't going to be the same as the answers that you get on the formula or the calculator. Okay, so obviously the best way to do time value of money is on the financial calculator because it's the most accurate and it's the most easiest way to get the right answer. The second method, that's not too bad, is to use formulas. Okay, then you would use the mathematical equations to work out the PV, the FV, the PMT, all the different variables. The last method that I would suggest no one use, okay, is the table method because it's just outdated. Right, remember, back in the day when technology wasn't big, think about it, like if you did this like 20 years ago, you had to use the tables. You didn't have any other choice. Okay, because they never invented financial calculators yet. Okay, but in today's world, technology is very readily available. So to have to use a table just doesn't make any sense. Okay, and that's my only reason for telling you not to use the table, because number 1, it's not accurate, and number 2, it takes a lot longer as well. Okay, so I'm going to use the calculator. We'll just put the workings for it. Where's it? There's it. Okay. Right, so all you're going to do is literally plug in your values. So you're investing that annually. So that's your PMT.
Yes, sir.
If you're investing, to be accurate, it'll be an outflow. So minus 2,500. At the end of each year, so that's normal end mode for the next 4 years. So N is 4. At a rate of 8%. Solve for, calculate the value of the investment at the beginning of the first year. Using the factor tables. Okay, beginning of the first year.
So N is 1.
So N is actually 1.
Yes. So it's future. Yeah, 2 point.
Solve for FE. Right, so if I grab my calculator and I solve for that, N is 1, I is 8, present value, payment actually, minus 2,500. Gives you a future value of, what did you get?
I got 2.5.
2,500, exactly. Okay, why? Because that's when you actually make the payment. So the value of the investment would actually be 0 until you've actually deposited or invested something.
Yes.
Okay, and if you're only investing at the end of every year, well then your investment will only grow at the end of every year. Right, so I don't even know why you had to use the factor tables there either. It's 2 marks. It was literally, it was actually common sense if you think about it as well.
Yes.
Okay. Calculate the value of his investment at the beginning of the first year. Doobie will be investing 2,500 annually at the end of each year for the next 4 years. Yeah, okay, there's actually nothing more there. Okay, I just thought maybe it's a trick question. Okay, so I'm reading it again. Okay, B. You always had this dream to one day experience a white Christmas. You have decided to go on this overseas holiday in 6 years' time. Okay, so that's your N. You need to start saving, as you will have to pay 6,000 for your overseas holiday. Okay, fine. So N is 6. You're going to have to pay, so you want 60,000. Okay, required. Calculate the amount that you will need to invest every year at a compound rate of 7% per annum at the end of each year to have the amount of 60 after 6 years. See, easy, hey? Do you agree? Yonem, are you still there?
Yes, sir. Yes, I'm still here.
Okay. Alright, so N is 6 years, future value is 60, I is 7,
Yes.
right?
Yes, sir.
What are you solving for?
For PV.
No.
Or for
PMT.
payment. Payment.
Yeah, why?
Yes, because it's a payment at the end of each year. So.
Yes. So it's the PMT, right?
Yes, sir.
Okay, so 6 years, 7%. You want 60. You're going to have to pay. What did you get?
You're gonna have to pay 8,387 and 75 cents.
Good, nice. C. Lawrence receives a performance bonus every year from his employer. He wants to invest 2,000 of this bonus at a rate of 5.5 for the next 3 years at the end of each year. Calculate the value of his investment after 3 years using the financial calculator. Okay, so here they're telling you use the financial calculator. Okay, so obviously then you would just do it like we're doing it here. So he wants to invest every year. So 2,000 is your payment. Yeah, your I is 5.5 and your N is 3, right?
3 years is N. So for the end of each future value.
Future value, yes. Okay,
Just
so 3, 5.5, payment of 2,000. What did you get?
6336.05.
Correct. Good, and that's it, eh? Easy, eh?
Yes.
10 marks for doing that.
Yes.
That's a nice 10 marks. Okay, but just be careful, as I said, this whole thing about factor tables. So now, I don't know, will they still give you the 2 marks if you didn't use the factor tables, but you didn't actually have to, because it was 2,500 anyway as an answer. This
Yes.
one said, what must we use? Okay, the formula. Right, so if you wanted to use the formula here, what are we trying to work out? Calculate the amount that you'll need to invest every year. Okay, that would have been the... this is looking for the payment with the future value of the annuity. Let me just get the formula for you. Okay, FV annuity. Where was that formula? Okay. Oh, that's the first book, not the second book. Wrong book. Okay, it was the first book. First book had the time value of money, hey? Yeah, it did.
Yes.
Okay, so first book had time value of money. This is present value, future value of an annuity. It's on page 83. Okay, so... See, if they're really specific and picky, if they do want you to only use the equation for it and not award marks for any other calculation, then you would have to do it this way. Then you would use this equation for this one. Okay, do you see that?
Yes, sir.
Yeah, that's what you would have to use then, if they forced you to use the equations, but it's not necessary. As you can see, you get the answer either way. Okay. B. Part B. Right, let's see what we've got. Okay, master cook companies making use of industrial food processors. Okay, so it's important to understand what business you're in. Okay, so I've got the business. Then I need to look at the required. Determine the net present value of the food processor economic by using the net present value method. Okay, so there I need cash flows. I need initial investment, OCF, terminal value. Okay, this is a capital budgeting question. Right, and then B, advise whether food processor economics should be replaced by food processor superior and motivate your recommendation. Okay, that's obviously the decision making after you've done the NPV calculation. Okay, nice question. We're looking at capital budgeting. Right, so we need to read the question, we need to highlight everything that's important, and we need to draw a timeline. That's what you need to do. Okay, so build a timeline. T0, T1, T2, T3, and so on. I don't know how many years we have, but we'll read it and we'll find out. Okay, so I need to draw a timeline. Let's go back and read. Okay, so part B. The Master Cook Company is making use of industrial food processors to process food and supplies the processed food to other food packaging distribution companies. The food processor economic is currently in use. They are considering replacing. Okay, so this is a decision to replace. Okay, so if I'm replacing an asset, I'm going to look at the new and the old.
Yes, sir.
Okay, the following information regarding the current economic food processor is available. Right, I've got the cost and I've got the current market value. This is for economic. So economic means currently. Okay, so this is the old machine. Okay, that's the cost, that's the market value, that's the useful life, that's the remaining useful life. So 3 years left. Maximum food processing in kilograms, so it's 6,500. Maximum sales, 6,000. Selling price, 1,560. And these are the estimated costs. Okay, that's for the existing machine. Okay, additional information. The annual meal production for the economic food processor will be limited to the maximum number of kilograms that can be sold annually. Okay, so obviously we're going to be keeping the sales and the production in line with the maximum sales. That's fine. Okay, the selling price per unit will increase with 11% in each of the last 2 remaining years. Okay, so that's an increase in selling price. That's important for the OCF. Okay, all the estimated costs will increase with 10% in each of the last 2 years. Okay, those are costs also. OCF. Let's write that down. Operating cash flow. Operating cash flow. Okay, what do we have here? This is annual fixed cost amount for year 2 and 3. Okay, then we've got net present value for the process has been calculated as. Okay, its present value of cash flows is that, and the initial investment is that. Right, so this is already the answer for the new machine. Do you agree?
Yes, sir.
Okay, that's the new machine. Current tax, 28%, is expected to remain unchanged over its useful life. Value-added tax is ignored. Tax authority allows wear and tear. Okay, so wear and tear of 25,000 on the food processors. Management requires 15% per annum after tax return on the capital. Okay, that's your rate. That's your discount rate. All the cash flows occur at the end of the financial year concerned, except the initial capital outlay. Is great. Is that it? Yeah, that's it. Okay, so all we need to do is we need to look at all the different changes. Right. The good thing is you don't have to do anything for the current scenario here, because you've already got the food processor here, which is the net present value of the new. Okay, so you've already got that information. That's given. You just need to look at the old. Okay, so currently, this is the information relating to the current. So this would have been the current food processor. Okay, so is there going to be an initial investment? No, there wouldn't. Okay, so no initial investment. Why? Because you're looking at the new minus the old. Okay, so so it's a little bit different here because they've given you it separately. You don't have to look at the new because they've already done that calculation for you. See? The net present value of the superior food processor has been correctly calculated as 30,000. Right, so they've already given you the net present value of the new machine. You're just looking at the old machine. Okay, so we're looking at opportunity costs linked to the old machine. Okay, so if we stop using the old machine, okay, what's the effect going to be? That's what we're looking at. Okay, so new minus old. Alright, so let's look at the old machine. The information relates to the current food processor, the current economic food processor is available. Right, so the cost price is 125,000 and the market value is 50,000. Okay, so if we're looking at new minus old, I actually would still want to try do a combined calculation, but the only problem is with doing a combined calculation is some of the figures you won't know because remember you've got the new asset which has already been given and you're just taking the old asset into consideration.
Yes, sir.
Okay, so normally you would go new minus old. Okay, but now I'm not because I don't have the new. I have the new, I don't have the old. Right, so I'm going to look at the old in terms of initial investment. Okay, in terms of the initial investment for the old, okay, before you would have had new minus the after-tax proceeds of the sale of the old. Okay, so the initial investment for the old machine would have been the sale of it. Okay, so what am I going to sell it for? Cost price, current market value. There's the current market value. So proceeds. Proceeds minus the tax. Brackets, this is the old sold. Okay, so my proceeds are 56,000. What's the tax on the old? Well, I need to check. Is there recoupment here? There might be. Remaining useful life. Okay, we need to check the base, the value of the asset to see if there's capital gains tax here. Okay, so okay, I need to do a separate working here. Okay, I'm going to move this down because I don't want to mess up the timeline. Okay. Alright, so this is initial investment. Bracket old only calculation. Okay, so the first step is to work out what is the carrying value at date of sale. Okay, so how do I work that out? Well, I need the cost. The cost was 125. Okay, how old is the asset? 3 years old. No, 2 years old. Remaining useful life is 3. Original useful life is 5. Okay, so accumulated depreciation for 2 years is how much? 125 times 2 divided by 5. Do you agree?
Yes, sir.
Okay, so carrying value for the asset is 75,000. Okay, how much did you sell it for? Current market value 56. So you would sell it for 56. Okay, so then I would have a you would have a scrapping allowance. You've sold it at a loss. Okay, proceeds 56,000, carrying value 75,000. Loss of 56 minus 75, 19,000. Okay, so there would be a 19,000 rand scrapping allowance that would come off the proceeds from the sale. Okay, so proceeds from the sale would have been a benefit. They would have come in. They would have been an inflow. Okay, so in terms of our diagram, initial investment, old relevant cash flows. Okay, the old relevant cash flows would have been an amount would have come in which was 56,000, which is the market value. Okay, that was what came in, and there's a scrapping allowance of how much? Oh, wrong page. There's it. 19,000. Okay, 19,000 times the tax. Okay, so the proceeds was 56. proceeds was 56, and then there's a loss. So the scrapping allowance.
So in the proceeds, do we put the 5.6 minus the tax, or do we just put the last?
The benefit is 19,000 times 28%. Did they give you a tax rate in here? Yeah, they did.
Yes, sir.
Okay, so you would have to take that into consideration. Okay, equals times 28%. Okay, is 5320. Okay, and because it's a scrapping allowance, you would subtract that from the proceeds, because it would basically be seen like almost like a deduction, if you will. Okay, so you get a benefit from selling something, then you don't have to pay as much tax. Okay, because you get a scrapping allowance actually on the actual sale. There wouldn't be any. There would be tax on the income, but the tax would only be on the income that was limited, greater than. If there was a capital gain, put it this way, the capital gain would only arise if you had a carrying value that was higher.
Yes.
Okay, yeah. So your proceeds were 56. They'll allow you a scrapping allowance of 5,320. So the difference would be what you would have here: 56000 less 5320. Okay, that would have been part of the initial investment. Okay, that's an inflow. That's a benefit. Okay, that's the first part. Alright, then the next part, second part, is going to be OCF. Okay, so now we need to do the OCF calculation. Do we have the years? How many years do we have here? Okay, here we had it here. Where is it? There's it. The selling price increase in each of the last 2 years. Okay, so how many years do I have left? Remaining useful life, 3 years. Okay, so year 1, year 2, year 3. Those are the 3 remaining useful lives of the old assets. Okay, I need to project what the sales are. Okay, so cost price I don't need, market value I don't need. Maximum annual food processing I need. Maximum sales though is 6,000. Okay, so revenue. Let's do it this way rather. Max sales 6,000 kilos. Okay, then the selling price. Okay, the selling price, okay, that'll be 6,000 for every year. They said that wouldn't change. The selling price, they said, will change. Okay, so what is the current selling price? 1560. Oh, that's the current selling price. That's times 0. Okay, what did they say about the selling price? The selling price per kilogram will increase with 11% in each of the last 2 remaining years. Okay, so the last 2 remaining years. They even gave you the sales though. Therefore, the sales amount for year 2 and 3 will be that and that respectively. Okay, so they actually gave you those figures. Let's just check if it's right. 11% times 1.11. Okay, so then revenue. Revenue would be your sales times your selling price. Yeah, you can see it's correct. See?
Yes, sir.
Okay, so see, those 2 figures need to be the same as those 2 figures. Alright, so they didn't have to give that to you, but they did. So you probably won't get marks for it. Okay, but you have to put it in. Does it make sense?
Yes, sir.
Okay, all the estimated costs will increase by 10% in each of the last 2 years. Therefore, the direct material amount for that, and that will be that respective. Okay, so we can use that as the costs. Okay, so direct material. I'm not going to do it the long way because they gave it to you in the answer in the questions. So I'm just going to insert it. Oh, but year 1 we're going to need. Oh, but year 1 didn't change, so it would have stayed the same. Okay, so where's my direct material? Direct material, 2 Rand 10. At 2 rand 10. Okay, so 2 rand 10 times 2 rand 10. Ooh, 2 rand 10. 2.1. Okay, and then times 2.1, and then times 2.1 times how much does it increase by? 10%. Okay, and then increase by another 10%. Okay, see, those figures are the same.
Yes, sir.
Okay, they must be the
What
same.
did you times by the 2.1? Was it the 6 kilogram?
Yeah, 600 kilograms, 6,000 kilograms times the direct material costs.
Okay, sir. Got that.
Okay, so that's how we're getting those figures there. Alright, so now I've dealt with 2, I've dealt with 3. Tick, tick. What else do I need here? Okay, they talk about the annual fixed cost amount for year 2 and 3 will be that and that respectively. And the annual variable cost amount for year 2 and 3 will be that and that respectively. Okay, so we can just insert those figures in. Okay, fixed cost in year 2 was how much? 37400. Okay, this one was 41140. This one was 13310, and this one was 14641. There we go. Okay, we still need year 1 though. So year 1 would have come from the question. Now I can tick that point. Where's year 1? There, current. Annual fixed cost excluding depreciation. Annual variable cost based on annual production. Okay, so 12,100 there, and 34,000 there. See that?
Yes, sir.
Okay, you got that there. Right, what else? Point number 4 we read. 5 talks about tax, value-added tax, wear and tear allowance on the food process. That's important. Okay, the annual tax, that's wear and tear allowance though. Okay, that's your tax allowance that you would get on the actual asset. You do have to provide for depreciation though. Okay, depreciation, which is the wear and tear, was how much? 25,000. Okay, so last 3 years left. 25,000. Okay, we actually worked that out earlier. Remember over here the depreciation? Remember 125,000 divided by 5? That gave you 25,000. Yeah, see? Same figure.
Yes.
Okay, so 25,000 depreciation, which is the wear and tear allowance. So now I've dealt with that. Okay, so I can tick useful life. I can tick that one. I can tick that one. I can tick that one. Okay, remember, depreciation, you take it off and then you add it back later. Remember that?
Yes, sir.
Okay. What else do I have here? That's it. Okay, so let's work out the amount before tax. Right, so revenue minus that, minus that, minus that, minus that gives you that. Okay, tax at 28%. Okay, profit after tax. Got that?
Yes, sir.
Okay, there's the profit after tax. Then you add back non-cash items, so depreciation. Okay, so you're going to add back the 25,000 to all of these. Right, and that's going to give you the operating cash flow. Okay, see that? Alright, so that's the operating cash flow for the old asset. So those figures are going to go up onto my timeline. Okay, so year 1, year 2, year 3. Okay, maybe let's just move this down and okay, that makes, okay, let's do it again. Okay, equals that. Okay, that's the OCF of the old. Right, got that.
Yes, sir.
Okay, then we need TCF. Terminal cash flow. Okay, I don't think I read anything in the question here about what I could set it at the end. Did they say anything here? Cost price, market value, useful life, the food processing, estimated costs, annual depreciation, all that stuff, variable fix, current management. Yeah, that's it. They didn't talk about the TCF here. Right, so I would assume that the value of the asset would be worth 0. Asterisk, no information given. Okay, you can't calculate it if there's no information in the question. Right, so I would just assume 0 here. Got that?
Yes, sir.
Okay, so now you've got these cash flows. These cash flows, you need to discount them back in time. Okay, to times 0.
Sir.
Right, so now I need to use this. Okay, and I now need to do a cash flow calculation. Okay, so year 1, year 0 actually, year 0 is 0. Year 1 is, oh, year 0 isn't 0. Year 0 is 50680. Year 1 is 32128. Year 2 is 35314.72. Year 3 is 38894.24. Right, I here was given management requires a 15% return. Solve for NPV. Okay, let's work that out. Grab a financial calculator.
Yes,
set
sir.
the cash flows and see what you get. 50680, 32128, 35314.72, 38894.24. NPV, what do you get?
So 38894.24. Second function. I can't second function yet. I haven't added I. Second function NPV is 130,893.987,343.
That's right. Good. Okay,
Yes,
so
sir.
what have you just worked out? You've worked out the net present value of the old asset based on the current situation. Okay, so now we need
Yes,
to
sir.
summarize here at the bottom. Okay, what did they say? Determine the net present value of the food processed using the EVA. Show detailed calculations of tax and scrapping allowance or wear and tear recoupment if applicable. Okay, we've done all of that. Okay, so that actually answers the first bit.
Yes, sir.
Okay, so we've answered that. That's what they wanted. Alright, solve for the net present value. Okay, then B is you need to give them advice. Okay, so A and B. This is A. Okay, B is advise whether they should replace or not. Okay, so I now need that bit that I had earlier. There's it. Okay, so the NPV of the new asset or new machine or new processor is, what is the net present value? The net present value was 30,000. Okay, its present values were 140 and the initial investment was 110. Okay, and then the NPV of the old processor. Okay, the old processor had an amount of where is that amount? Oh, hold on a sec. I made a mistake with the cash flows. Okay, because remember, okay, I was looking at this diagram in terms of the whole project, the new and the old. Okay, so do you agree? These old cash flows, this 50,680, do you agree that would have been an inflow or an outflow for the business if they had to replace the asset?
Yes, sir.
Which one? Inflow.
Yes,
because if they sell the asset, they're going to get a benefit.
Yes, sir.
Okay, what do they forego? They forego the benefits of the revenue that comes from the asset. See, that's the negatives. Okay, so we actually need to fix this, because these should have been negative amounts, because that's what you're losing out. Because see, the thing is, they're not doing the incremental calculation where they've got new and old. They're doing old separate from new. Normally you have to do it together. Okay, that's why we have to make those negative, and that's positive, because then we need to offset the two NPVs. Okay, so redo. Go back to the calculator. Put negatives in here for these ones. Okay, so minus 3232128 minus 35314.72 and minus 388494.24. Yeah, solve. Okay, that gives us a negative. That's better. Okay, that gives you negative 29533.98734. Okay, let me just put some theory here. This represents the opportunity cost of the old asset being replaced. Does that make sense?
Yes, sir.
Okay, so now we've got that. Let's put that down here. What's that figure? Okay, let's just copy it and paste it here. Okay, there's the value of the old. Okay, so that's the new processor based on its calculation. They didn't want you to do that calculation, because then this question would have been out of a lot more. They only wanted you to process the old. Okay, the net effect, net present value, if that makes sense, net present value, okay, will be this plus that gives you that. Okay, so there is a small benefit. Right. There is a small benefit in terms of buying the new machine to replace the old machine. Okay, 466,01 is the net present value, brackets, this is the additional benefits created. Okay, asterisk based on the NPV calculation. NPV greater than 0, the asset should be replaced. Other reasons to support the replacement would be to increase potential capacity. Based on the info in the question, demand stays at, what is it, 6,000 units, yeah, 6,000 kilos, 6,000 kilograms per annum. Should this change, in the future, the new assets will have greater capacity to produce more goods. Okay, so that's just something additional. You probably don't have to mention that. It was like, what, 2 marks? Yeah. Okay, so advise whether the food process economics should be replaced. The answer would be yes, it must be replaced. Let's write that down. Yes, it must be replaced. Okay, and then explain it with all of that stuff. Okay, and that's it. That's May June 2017 first semester paper.
Yes.